Hi, my name is Reed Silverne. The name of the show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker and proud of it, retired. And today, finally, a week and a half after the election, I've gone casual, as you can see, because I'm just tired of everything. And first, let me say that this is live to tape. If I fall off the chair, or if I do something silly, you will see it. For me, it's Friday the 14th. For you, it's probably Sunday the 16th or Tuesday the 18th, depending on what channel you see me on and so on and so forth. Now I'm going to deal with the subject of As you've seen, or as you just heard, I said it about 8 times already, I have been in Toastmasters, and I have broken the record of because they count uhs in order to try to teach people to stop doing it. But I'm afraid that when I watch my uhs, I can't talk. And if I can't talk, I can't do this show. So you're just going to have to cope with it, and I'll do my best. And maybe I'll change to and or it or something else. But for the most part, I still say So that deals with the issue. And it is an issue that is very, very much on my mind every time I do the show. Naturally, the amount of impact that I have on the world and the world history, I probably have a greater impact on the use of the word than I do on the nation's economy or the nation's policies. As everybody knows, Obama's been elected. I haven't made a secret that I was voted for McCain. However, I wish Obama the best. He has nothing but problems right here. I have to get my, I said it again. Now I am noticing it. My mouse so that I can move the world and switch it and so on and so forth. Okay, somebody has messed with the location of the center of the screen, so I can only move it backwards and forwards, which is fine. That doesn't cause me a problem at all. So what is the issue of the day? The issue of the day is the economy, of course. I've been talking about it for quite a while, and I have blamed the world economic crisis on the creation and invention of derivatives. Now, they've had a lot of talk about credit swaps. Credit swaps are just a part of what derivatives are. And the fact of the matter is, the latest part of the crisis to try to get a lot of attention now is the credit card market and also the car loan market. Detroit is collapsing. Basically, we have 3 major American car industries. Chrysler had been bought by Mercedes and then got spun off. I forgot what its name is, something like Cerebras or something. GM, their stock has gone from the 20s and 30s down to about 3, the lowest in its recent history. Ford has gone from down to a little under 2 in some cases. Sometimes it's a little above, sometimes a little below. And I have no clue what Chrysler is at. Chrysler has more cash than GM does, and Chrysler wants to join up with GM, who's not getting any help, which is surprising to me because basically the government gave Merrill Lynch to the Bank of America, gave Bear Stearns to, I believe, Morgan, Citibank, WAMU, I believe, was supposedly was given to Citibank. Wells Fargo took over Wachovia, but only because it was going to be given to a different bank that was going to pay nothing for it. And Wells Fargo wanted it so much they paid $15 billion instead of $2 billion, which was the borrow loan. So it seems to me, and I'm completely on the outside of where all the pundits are. The pundits are just let the U.S. car industry collapse. What could be better? That's what bankruptcy is for. Yet they didn't seem to think that's what bankruptcy was for when it came to their industry of finance. So I watch CNBC, I watch all of these finance shows, and they are just let the car industry collapse. Who needs it? Well, we don't need to make our own cars. We can buy them from Japan. or we can let the Japanese and the Germans build car plants in America if they want to sell to us, or we can just import it from overseas, which I say is complete and total garbage, because we can borrow money from overseas too. We didn't need Wells Fargo. We didn't need Bank of America. We didn't need Citibank. We don't need a banking industry. We have a banking industry that has gone out of its way to destroy our economy. And we have 700,000 direct jobs. We have 2 million indirect jobs, all supporting the car industry. Canada has another 500,000 direct jobs. And what people don't worry is that, oddly enough, Europe is probably going to bail out the car industry before we do, because Ford has Rover over here. Ford has practically owns the entire city of Cologne in Germany, where they produce the Focus and the Ka and a bunch of other very small and very peppy cars, because I've been in them. Opel is right near between Wiesbaden and Frankfurt. I lived in Wiesbaden for 4.5 years. And on the way to the airport, I'd take the train. It would stop in Rüsselsheim. The entire city of Rüsselsheim and the entire urban area around it is all dependent on Opel, which is part of GM. GM has giant plants in Spain. So apparently, approximately 2 million people are in the car industry in Europe. And all of the European car industries are in trouble, not just GM and Ford, or Opel, which is represented by GM. And GM, I believe, owns Saab. Although I believe GM owns Saab and Ford owns Volvo. But I could have it mixed up. So all of these car plants and car companies all over Europe are also GM. Also, GM has gigantic plants in Sao Paulo in Brazil. Basically, it was one of the main things that industrialized Sao Paulo was GM, and GM produces a lot of its cars for the Brazilian market, and not just the Brazilian market, but all Latin America in and around Sao Paulo. So the fall of the 3 U.S. automakers is a much bigger deal throughout the world, especially in emerging markets, could collapse economies in other parts of the world as well, that we could probably afford, but the Europeans probably can't, because they're more dependent on foreign trade than we are. So in my opinion, if we got $700 billion, the banks are doing nothing with the amount that they have received but abusing their privileges. And the entire finance industry, as far as I'm concerned, the people that design derivatives need to be investigated for fraud, because derivatives, by definition, if you even know what they mean or how they work, you could see that they were a Ponzi scheme and a fraud. The problem is, and it started with the mortgage derivatives, but now it's spreading to credit cards, car loans, and so on and so forth. What's the best way to start up the car loan market? Cars went down 6%. Even as the price of gas was going down, car sales were going down too. The main reason is you can't get a car without a credit score of 700. That is ridiculous, because if you price the car correctly and you make them come up with a little bit of down to cover the depreciation for the first year, all you have to do is repo the car and you get your money back. So why isn't a car loan a good loan down to anybody who seems to have the capability of paying it? Most people buy small cars, and the people who buy small cars or cheap trucks usually have a payment in the on the order of $200 or $300 a month. The more expensive cars, more like $400 or $500. And certainly, you can give a car loan to somebody with a job and an income that can cover that kind of amount. Why don't they? I will tell you why they don't. And the main reason is because we allowed the thieves, the frauds in the finance industry to create these new derivative markets that were garbage. And what have we done? We have destroyed the original method of buying and selling car loans, credit card loans, mortgage loans, and everything else. What do? We let these people who were cheats and who need to be put in jail if they are convicted, and I think that a good prosecutor can convict them. What they did was they created bonds. Now, what is a bond? If a company wants to build a new plant, they issue a bond. There's a large investment bank that usually sets up the deal. A bond is basically a loan, and the company guarantees that out of its profits and before anything else, even dividends, they will pay the interest on the bond until it matures. And then when it matures, they'll either borrow the money through another bond to finance the other one, or they'll pay off the bond. Either way, the bonds were very, very stable, fixed income investments that were basically sold mostly to retirement funds and mutual funds and so on and so forth. And also big companies, insurance companies. Basically, if you had a bond, that was a good investment. You could basically count that the company would be paying off its interest on its loan before almost anything else. So it was a good deal. Now, what did they do? They took any set of loans. And of course, I've talked about this in relation to the mortgage industry, but apparently they were doing it also for credit cards, for car loans, for student loans. Everything were being put and repackaged as derivatives. So what they would do is they would sell you a bond, except it's not a bond. I have a bunch of car loans. I have a pool of car loans. And what I do is I give you a guarantee on the cash flow from these bonds, from these car loans of, let's say, 6%. And you buy the derivative. And it was for the most part, stupid people in banks who were trying to get a higher interest rate than they could get out of the treasury markets. They were conned, but they wanted to be conned. And it's all part of the general fraud that is the what they call debt securitization industry, an industry that never should have been allowed to exist and has got to be destroyed as part of the solution to our economic problem. We should not reconstruct it. We should not buy it out. We should not recreate a market in it. We should ban these things because what they are, the buyer of the bond, the buyer of the derivative, called a debt securitization, he does not buy the car loans. He buys a series of swaps, of credit swaps, that guarantees that the bond will be valuable no matter what. So basically, those are side bets. So if the debt default rate goes up, there's a swap. And a certain company, and that was mostly AIG that went bust, Lehman Brothers that went bust, Merrill Lynch that went bust, they sold the swaps, and in return for, let's say, $100 a month or something like that, the buyer of the derivative got a guarantee that was part of the package that if the loans and the car loans that were in the pool defaulted and the default rate was above a certain level, that they would get their money back. Well, what happened was the people that were issuing the swaps were asking for 1% or 3% of the total amount of money that they would have to pay if they got the default rate up to the level that would trigger the swap. So the whole thing was a fraud. It was a cheat. It was ridiculous. Anybody who looked at it was ridiculous. And what is it? It's the equivalent of if you play blackjack and before you take a hand, You say, I have $1,000 to play blackjack with, and I want an insurance policy that if the dealer gets a blackjack, if he gets and I don't have a blackjack, that I will be paid anyway. I'll be paid back whatever I could possibly lose. Well, you know how the cards are. There's a lot of kings and there's tens, jacks, queens, and kings, the tens, and there's 4 aces in there. And it's very, very possible that the dealer can get a blackjack when you don't have one. But what they did was, let's say that there's a 10% chance or a 5% chance of a blackjack when you don't have a blackjack. So instead of paying 5% of the total that you have of your $1,000, $50 to cover the possibility that if he comes up with a blackjack and you don't, your bet is paid off, or your loss is paid off. What they did was, instead of $50, they only charged $1. So when the dealer finally got a blackjack, he's going to get a blackjack if you play long enough. You didn't get your money back. And that is what happened. So the derivative, which was based on a claim of cash flow from a pool of loans that's owned by the issuer of the derivative, and you have that claim, but they also sold you, as part of the package, these swaps that supposedly protected you if the default rate went up, in which case you're probably not going to get your bond money back, because it wasn't a bond. It was never a fixed income. It was a gamble. It was playing blackjack. And the swaps that were behind it, they were supposed to set it up so that no matter what happened, just like in a bond, if the company, unless the company, and I'm trying to think of a company that's really stable, Microsoft, goes bust, basically you're going to get your interest on your bond. And if that's 6% bond, you're going to get your 6%. Now, what they did with the car loans, what they did with the mortgages, what they did with all these other things, with credit cards, with student loans, you name it, is they based the entire loan industry on selling them to these thieves and frauds who issued derivatives and replaced whatever the market was before that. If you ever had a mortgage in the 1990s or 1980s, about once every 2 or 3 years, you'd get a letter from your mortgage company that said, we sold the mortgage to another company. And that company now send your mortgage payment to such and such an address. If you're on top of things, you did it. If you didn't, you could ruin your credit because they wouldn't take your payment anymore because they weren't your mortgage company. There was a market in selling mortgages after the mortgage was written. That market collapsed. All the companies that did that are out of business because they replaced that whole entire market with debt securitization bonds, with derivatives. Derivatives that are in their basis fraud and a Ponzi scheme. So what's happened now is one of the reasons the car industry is in such dreadful trouble. One is because the price of oil went up temporarily, and that has to do with a different kind of derivative that was being issued against commodities. Fortunately, the CFTC ran those people out of that business, and they didn't yet destroy the original futures trading system for the people to buy and sell commodities. However, we as a country, and not just us, Europe, Asia, the entire financial system, forgot how to resell mortgages, to resell student loans, to resell car loans. And now that the debt securitization industry, in other words, the fraud industry, the theft industry, the industry of taking your money and keeping it and stealing from you and destroying your retirement, that industry has collapsed. Nobody will buy them. Why? The reason they won't buy them is because all that had to happen is one company or one person that bought one of these phony bonds, one of these debt securitization bonds or derivatives based on car loans, the default rate went up, and the swap company, which is probably AIG or Lehman Brothers, was out of business. They didn't collect enough in the first place to cover your hedge. In other words, to cover your possible loss. They only collected 1/100th as much as what was required to cover your loss. Now there's a slight recession. It's not really that bad yet. It's getting worse, and it will get worse, but it's not that bad yet. And yet, the default rate has gone up. And the swap that backs up the bond is now worthless. So if the default rate went up, you don't have the loans. Somehow or other, if they want to save this industry, they have to make sure that whoever sells a derivative has to sell the asset that's underlying that derivative. But if they're going to do that, then just buy the mortgages. Why buy a bond? If you want 6%, buy a bunch of pool of mortgages that pay 6%. You collect the 6% and it's yours. You have it. What do you need to buy a fixed income on something like that? No, it's ridiculous. Nobody needed to do that. The swap industry has collapsed, and it didn't need to collapse. However, if they had valued the swaps at what the value of the risk was, nobody in the world would have bought it, because it's just like regular gambling. If you go in there and you play craps, and you have the pass, and there's a 636 or a 536 chance that you're going to roll a 7, and you buy a don't pass, they're not going to charge you 1/10 of what the value of the don't pass is, because the house wants to make its edge. If you take a don't pass bet and a pass bet, you're going to lose money. And that's the way it ought to be. Somebody's got to play the dealer, and somebody's got to make profits for the gambling outfit. What they did with the derivatives is they set up a whole bunch of things, convinced people that they could have a cover against any possible bad instance, against every possible risk, and at the end of that, you'd end up with a profit, no matter what happened. Well, that's stupid. Anybody who believes that is a dummy. And basically, we have all the major banks in the world believing it. We have all the major retirement funds believing it. And all they had to do was come to me, and I'm not much of a super investor or an intelligent person. I'll tell you, if you have a reasonable hedge, in other words, if you have a bet covered on the opposite outcome for every opposite outcome, somebody's going to be collecting their fee, and you're going to end up putting out more bets than you're going to receive. It's obvious. Anybody who knows a thing about gambling and can add up the numbers knows that there's an edge for the house. And even if the edge for the house is just paying the salaries of the people who work for the issuer of the derivative and paying the fees on the derivative, knows that he's not going to set this thing up so that you're going to make money no matter what. He's got to make some of that money. So it was obvious to anybody that this whole thing was doomed. And yet they allowed the market that resells mortgages the normal way, that resells student loans the normal way, that resells car loans the normal way. They let all those companies go completely out of business, so they don't have a way to resell the car loans once they're made. So now nobody will buy the derivatives based on car loans, and they don't know once they give a car loan, unless the car company that's completely out of money, GM, covers all car loans for GM products, there's no place to sell it. There's no place to sell that loan, and nobody there to go repo the car and get his money back in case somebody doesn't pay their car loan. So the result is the car industry is in trouble, the credit card industry, and as a result, all retail's in trouble. And we've got to figure out how to replace the derivatives market with markets that really work. Thank you very much. My name is Reed Silverne, and thanks for watching.